Welcome to this YouTube channel. In this video we are going to talk about common investment mistakes to avoid. So before starting the video, please like this video and subscribe this YouTube channel for future updates. Every single person will, at some point in their life, act foolishly. Some of them aren't that big of a deal, like unintentionally hitting the reply all button and showing a private message to all of your coworkers. Some decisions might have more far-reaching repercussions than others, and this is especially true when it comes to the management of your money. If you make a mistake with your investments, it has the potential to cost you hundreds or even thousands of pounds. Some mistakes are readily visible, while others might not become apparent until much later in life, at which point the harm might be more difficult to undo. You're at a cocktail party, and the blowhard comes your way gloating about his most recent stock market move. This scenario plays out for the vast majority of us at some point or another. This time, he has decided to take a long stake in widgetsplus.com, which is the most cutting-edge online marketer of home gadgets. You find out that he is utterly enamored with the firm even though he knows nothing about it, and that he has invested 25% of his portfolio in the hope that he will fast double his money. You, on the other hand, start to feel a little superior as soon as you realize that he has made at least 4 of the most typical blunders investors make. Here are the 4 errors that the local blowhard has committed, plus 4 more for good measure. Here are 10 of the most common and costly blunders that may be made when investing. Number 10. Putting aside inflation. Because they mistakenly believe that investing is more dangerous than just retaining cash, many people do not invest any of their money and instead store it entirely in savings accounts. On the other hand, if the interest rate on your savings is lower than the rate of inflation, the value of your savings in real terms will steadily decrease over time. There are a few different approaches that may be taken to protect oneself from the eroding effects of inflation. However, research conducted over extended periods has shown that none of these approaches have been as reliable as investing in the stock market. Number 9. Making it impossible to build up a rainy day fund. Even if investing provides your money the chance to grow, you should also be sure to save some money in case of unexpected expense, as by putting some money away in a rainy day fund. It is common sense to have sufficient funds in an account with quick access to cover critical expenses for around 6 months. Your emergency fund can assist you to avoid having to take out loans or sell investments that have lost value if your boiler breaks down or you receive a huge, unexpected charge. Number 8. Omitting your tax credits and deductions. Your financial situation may see significant improvement if you make investments using tax-advantaged vehicles, such as an individual savings account, ISA, or a pension. You are not required to pay any taxes on the income or gains from investments held within an ISA, and you are free to withdraw the money at any time without incurring any further tax liability. Because personal payments to pensions are eligible for a tax benefit of 20%, this means that a donation of £100 will only cost you £80. Taxpayers who are subject to higher rates or additional rates are eligible to get additional tax relief of up to 20% or 25%. Respectively. Number 7. Failure to diversify one's holdings. You're probably familiar with the proverb that advises people not to put all of their eggs in one basket. These are words of wisdom to live by when it comes to financial investments. If you diversify your investments over a variety of asset classes such as cash, shares, and bonds, as well as across a variety of industries and geographic locations, you may be able to reduce the impact of any one type of investment's poor performance on your overall portfolio. It is not easy to put together a varied investment portfolio on your own, but a financial consultant may assist you in getting the process off to a good start. Number 6. Considering only the immediate future. The stock market is known for its high degree of volatility, which manifests itself as fluctuating share prices from one week to the next. For this reason, you should have a long-term perspective while investing and invest for at least 5 years, but ideally for a longer period. When you invest for the long term, your money has the opportunity to rebound from declines in the stock market and increase in value over time. Number 5. Making hasty choices as a solution. It's quite simple to feel panicked when the stock market takes a tumble. But acting on impulse can put you in a worse financial position in the long run. When you sell investments that have decreased in value, you run the risk of realizing a loss. And if there is a quick recovery in the market, you run the risk of missing out on further gains. A financial advisor can help you invest in a way that is objective and sensible even if you have trouble maintaining your composure when the markets are plummeting. Number 4. Avoiding taking a loss by any means. On the other hand, one of the most typical errors investors do is to refuse to accept a loss and to continue to hold on to a stock that is underperforming, in the expectation that the share price will eventually rebound. But, if the market conditions have shifted, keeping your money locked up in a business with bleak prospects rather than reinvesting it somewhere else where the returns are expected to be higher could end up being very expensive for you in the long term. Number 3. Keeping up with the herd. The fear of missing out, or FOMO, affects all of us at some point in our lives. However, modeling your financial decisions after those of your friends, neighbors, or coworkers may not be a good idea. There are a lot of ventures that are overhyped, and then they crash and burn a few months later. Even if it appears that the investment is sound, that does not mean that it is appropriate for your particular set of circumstances. Number 2. Confounding one's thoughts with a rising market. When stock markets are flying, making money feels easy, but it is important to realize that a good couple of months in equity returns does not make you Warren Buffett. Investing is a difficult endeavor, and to do it correctly, you need to dedicate a significant amount of time, effort, and knowledge. When there is a lot on the line, it's usually in everyone's best interest to defer to the professionals. Number 1. Failure to gain wisdom through experience. When many of us reflect on the choices we made about investments in the past, we can realize that we were not as successful as we would have liked to have been. Examining your mistakes as well as your accomplishments is necessary to do as an investor, even though failure can be a difficult thing to admit. You won't need to worry about repeating the same errors in the future thanks to this information. When it's done right, investing could help you build a more secure financial future. When it's done wrong, you risk losing money and jeopardizing your long-term plans. A financial consultant will assist you in investing in a manner that is tailored to your unique requirements and objectives, giving you the peace of mind that comes from knowing you are handling your finances responsibly. Get a handle on your financial situation by consulting with one of our financial consultants as soon as possible. It is possible that the value of investments, as well as any income derived from them, will decrease, and that you will receive back less money than you first invested. The value of an investment could go up or down depending on how the value of the underlying currency moves. This does not constitute tax or legal advice and should not be taken as such. How taxes are handled is determined by the specifics of each client's situation and may be subject to modification in the future. The information is simply presented as an illustration. It is not intended to be taken as a recommendation to pursue a specific strategy. What do you think about this video? Do let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.